Has the Bitcoin decoupling already started? Bitcoin's up 150% this year, while bonds are down more than 50% from their peaks. And everybody is looking at the fact that the yield curve actually inverted 17 months ago, and they're scratching their heads just a little bit. They're saying, where is this global recession? The yield curve inversion has actually predicted every single recession over the past 50 years, and we normally see this recession 13 months on average after the yield curve has inverted. So we've been waiting for 17 months now. The only other times in history that we have had to wait longer than 17 months after a yield curve inversion before we see a big crash was 1929 and 2008, the two worst crashes in history. So are we on the precipice of seeing a Great Depression 2.0 stock market crash? And has Bitcoin already decoupled from the macro markets? Stick around to the end of today's video because the answer to both of those questions might surprise you, but let's begin answering these puppies by looking at this thing that everybody calls the yield curve. Now, we don't want to get too granular. We don't want to get lost in the weeds with our TradFi macro friends in today's video. We're going to keep it super simple, super high level. Everything you need to know about the yield curve is going to be in the next 66-second video that I play for you guys right now.
Traders often look at the bond market for clues on how the U.S. economy will perform, specifically the yield curve.
Given the yield curve inversion,
we inverted back in March.
Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
The president tweeting out crazy inverted yield curve.
So what is the yield curve all about, and why is everybody talking about it? The yield curve is just a graph showing the relationship between short-term and long-term interest rates of U.S. Treasury notes. Usually the short-term rate is lower than the long-term one, but if you are lending money to the federal government, which is essentially what happens when you buy a Treasury note, you are taking a bigger risk by letting the government have your money for a longer period of time. So you're going to want a higher interest rate to compensate you for taking on that risk. But sometimes this relationship changes. If the two rates start getting closer together, that's called a flattening yield curve. If the long-term rate dips below the short-term rate, that's what we call an inverted yield curve.
So I hope that's not too complicated, okay? All a yield curve inversion means is short-term debt has a higher yield on it, and that is because the big boys are dumping their short-term debt. They're saying, look, a recession's going to come in the next 90 days or the next 2 years. I'm going to dump this government bond because I don't trust that it's going to be solvent in the short term. I'm going to dump all of these bonds, and this causes the yield on these short-term bonds to rise, and it's going to rise even higher than the yield on these long-term bonds. That's all we're going to say on the yield curve inversion. Let's move on. So the fact that we have one of the deepest yield curve inversions in history is what's causing FinTwit to be a little bit bearish over the past couple of years. You might remember hearing from all of your macro friends that the recession is coming. You've probably heard of them talking about this recession for the past 2 years, and it still hasn't come. But why? Is it because we've already had the recession? Is it because this time is potentially different? Let's run through these scenarios for you guys today. So we can see from this chart here, every single time the yield curve inverts, it goes red on this chart. And you can see just after that little area of red, you see a big gray bar. And that means you get a recession. And everybody has been predicting the end of the stock markets. You know, a massive recession is coming for the past 2 years because the yield curve inverted in July of 2022. But guess what? It's December 2023, 18 months later, we still haven't seen this glorious depression that everybody's been calling for. Now, what's interesting is the only other 2 times in history that you've had to wait more than 16 months since the yield curve inversion to when you get the recession have been 2 of the largest crashes in history, okay? We can see here, the yield curve inverted in 1927. And what happened only 18 months later in 1929? We obviously saw the biggest stock market crash in history, okay? It was more than a 90% crash, and it led to a 10-year depression. So, and what happened the other time that you had to wait 16 months before you saw the recession that happened after the yield curve inversion? Well, that happened in 2007. We can see the yield curve inverted in 2007. 2008 come along and we saw an absolute bloodbath in the markets. S&P 500 down 50%. We saw literally the entire global financial system hours away from melting down. ATMs were going to be closed. Nobody was going to be able to get their cash. It was going to be a Great Depression 2.0 until the money printers fired up. So, the yield curve inverted 18 months ago. Are we about to see a crash bigger than 2008 and 1929? Well, I'm going to actually make the case for why we are going to see a crash bigger than both of those events at the end of today's video. But I first want to look at a few of the other reasons for why we haven't seen this recession yet. The first being that we already had it. There's a camp of people out there who actually believe that we have already seen this recession. So the yield curve inverted in July 2022. What else happened in the first 2 quarters of 2022? Well, we actually saw negative growth. And this is interesting because before 2022, the technical definition of a recession was when an economy saw 2 consecutive quarters of negative growth or negative GDP. That's exactly what happened in America. Q1, we saw GDP growth of over -1%. And then in Q2 2022, we also saw growth of -0.9%. But this is when the Fed came out and they said, well, you know what? We're going to change the definition of a recession. This no longer signifies that we have a recession. We can see here that the White House goes on the offensive to argue that the US is not in a recession. They said, look at the job market. The job market is strong. This changes history. We're going to change how we actually call a recession because they said the job market is great. Why do they say that? Because they fudged the numbers. We can see here, the unemployment rate is not at 3.9% like Biden tried to claim in 2022. If you look at the way our own governments used to measure unemployment, real unemployment today is over 20%, and that is nearly as bad as it was in the Great Depression 2.0. Nearly as if we are already living in a silent depression. I'm going to talk a little bit more about the silent depression later, but I want to talk about the second reason for why some people are saying that this time is different and we don't necessarily need to have a recession.
So if you're enjoying all of the in-depth analysis that we're bringing you into today's video, I wanted to quickly interrupt it and say you can find all of this and more in our free newsletter that we published on this topic. It is linked down below in the description of today's show notes, but we not only cover the 1929 Great Depression, we also talk about all sorts of other things in that newsletter, like the Bitcoin double halving. We also talking about the supply suffocation that is coming in 2024. We publish one of those every single week, so I would encourage you to check it out if you are enjoying today's video. But with all that said, let's get back into the rest of this video and find out why Bitcoin is about to decouple from the traditional markets.
And this all has to do with the economic Cold War we're living in today. So this second reason is what I believe is probably the more plausible reason, okay? So for the first time in 50 years, bonds from all around the world are no longer being respected. They're being disrespected. Nobody wants bonds because for the first time in 50 years, inflation is sustainably up above 10%. And this is causing many people around the world to actually reconsider all of their other preconceived beliefs about what is a safe instrument, okay? Treasury bonds are no longer as safe as they used to be when real inflation is probably around 10 to 15% if we look at shadow stats, which again is how our own government used to measure inflation. Again, quick maths tells you that if you're holding a bond that has a 5% yield and real inflation is 15%, then you're losing 10% of your money every single year. That's not the best economic decision. Now, the second reason why bonds are no longer very safe is because what America did to Russia in 2022. They said those $400 billion of bonds you've got, sorry, Russia, we're going to take those because you're a bad actor. So 2 big reasons of why people don't like bonds. And that's why we can see all across the yield curve, bond yields are going up. Now, again, simple bond math for today's video. All you need to know is that when a yield on a bond is going up, that means the price is going down, okay? When somebody is buying a bond, okay, that means there's lots of demand for bonds. What happens is the yield goes down, okay? We're not going to get too granular. We don't want to confuse or lose anyone. All we can see by is that all of these charts rising with the yields going up. That means price of those bonds is going down. We can see here, look at the yield on the TLT. It's going up, but you can see on the other side of the screen, the price of the TLT is going down. The TLT was down more than 50% since 2020. So I hope that kind of, clears the air about how bond prices work. They are very complicated, and I've had the pleasure of talking to Greg Foss on a number of occasions, and eventually you can wrap your head around how bonds work. So let's move on. That's the second reason for why things could be a little bit different. What's the third? We have global de-dollarization. So we have countries like the BRICS who are now trying to de-dollarize their entire economy. They're dumping US treasuries from their reserves. They're trying to set up payments outside the US dollar. I don't think they're having huge success with this right now. We can see there's a couple of very fringe deals that are being made by, some of the Saudis are selling oil for yuan to China, but I don't think this is something huge that's going to happen overnight, that we are actually de-dollarizing the global economy in terms of transactions. I think it's far easier to actually shift what's in your reserves than what you transact in, and that is what we are seeing. China is selling an enormous amount of treasuries. The same is true for Japan. They're the world's two largest treasury holders, and they're absolutely dumping treasuries. So now I'm going to put on my bearish cap, okay? This is the best I've got for today, but this signifies Luke is bearish. And now I'm going to make the case for why we could see a crash in 2024 that could actually be bigger than 2008 and 1929, okay? So why am I making that case? Well, what we have is some very similar ingredients today in the 2020s that we saw in the 1920s. So what caused the Great Depression and the enormous great deleveraging of the 1930s? It was because we built up too much credit, too much debt in the system. You can see most people would have heard of this thing called the Roaring Twenties. That was all built upon unsustainable debt. Yes, people were having a great time. Everybody was getting rich. Everybody was dancing in these black and white videos, but that was because there was too much money sloshing around in the system. Almost sounds a little bit like the 2020s, don't you think? And you know what they say about an over-leveraged economy? Eventually, it has to deleverage. And that's what happened in the 1930s. And it looks as if something similar could be happening today in the 2020s if I have my bearish cap on. And this reminds me always of Mark Twain's famous quote, "History never repeats, but it often rhymes." Because we can see here, we have enormous credit expansion today in our global economy. Some people would actually call it an everything bubble. We had a huge tech stock bubble in the year 2000, but the economy didn't deleverage. Instead, we created a bigger bubble in the housing market in the 2008 bubble crash. But none of that deleverage. Instead, we just kicked all of that debt up to the sovereign level, and now we have a government debt bubble. So as you can see, this is why we call it an everything bubble. Now, what's interesting about this everything bubble and whether it is going to pop is this chart right here. So this shows that the deeper a yield curve inversion is, the more negative that chart gets, the bigger the crash tends to be. Now, the only inversions in history that have been bigger than the one we're seeing today happened in 1978 and 1929. And they were some of the bigger and the more volatile periods in financial market history. So, are we going to see a massive volatile crash? Is Bitcoin going to actually decouple itself from a deflationary spiral? This is very counterintuitive because most people just think that Bitcoin is, an inflation hedge. It's digital gold. That's all it's going to be. But I don't think it is that. I made the case in a 2021 article that Bitcoin is actually a deflation and an inflation hedge. Now, again, we don't have a bunch of data to base these assumptions off, but I do think it's interesting during the March 2023 banking crisis, Bitcoin rallied like 50% in the space of only 8 weeks. Now, what if this crash has already happened? Now, I always like to, look at things a little bit outside of the box. I always like to come up with some different theories, and I have a theory that the markets have already crashed. So let me explain my crazy point for just a second. This here is the S&P 500. We can see it nearly ticked a new all-time high just as I'm recording this video when you denominate it in dollars, we can see that the S&P 500 is actually more than tripled since the year 2000 when you price in the S&P 500 in US dollars. But when you account for the fact that the money supply has actually been enormously expanded over the past 20 years, we can see the S&P 500 is actually down more than 30% since its 2000 peak when you're denominating this chart in the expansion of the monetary supply. So I've made the case, and I'll make it again, that markets have already crashed. What we need to be looking at is actually what's outperforming the expansion of the money supply. And surprise, surprise, one of the few assets that has outperformed the expansion of the money supply is Bitcoin. But this gets us to the point. What if we do actually see a nominal crash in the stock markets? I don't know what's going to happen. I'm making the case that things have already crashed, but sure, I mean, we could get a 30 to 40% crash in the stock market. And what's this going to do to Bitcoin? And then we need to consider the fact that Bitcoin is actually going to have a halving in 2024. Some people are saying it's going to be bullish for Bitcoin. Some people are saying the halving doesn't matter and all that matters is liquidity in the system. Well, if you want to learn a little bit more about what I believe is the Bitcoin double halving and why Bitcoin could decouple itself from macro even in an environment of declining liquidity, well, you guys are in luck because we did recently film a video on that topic. I'm going to slap a link on screen right there, and that's going to take you straight to that video. And with all that said, let me know in the comments down below what you thought of today's video. Let me know what you think of the video I popped up on screen right there. And with all that said, hope you guys have a great day. I will see you all in the next one.